Welcome to episode 3 of the Option Basics series. In the previous videos I explained what call and put options are. If you haven't watched those yet, I highly recommend checking them out first. They will give you the context you need for today's topic. In this episode we are going to talk about selling options, both calls and puts. I will walk you through real examples, explain when and why traders use this approach, and discuss the pros and cons of being an option seller. Before we dive in, make sure to check out optionwise.eu for more content like this. You can sign up for the newsletter and grab your free ebook Options 1-on-1, your first step towards smart trading. It's perfect if you are just starting out. And if this video helps you out, don't forget to like, subscribe and share it with others. It really helps the channel grow. In the earlier videos, we looked at options from the buyer's perspective, which I believe is the best place to start. It helps you to understand the core idea what a call option is, a contract that gives you the right to act but never the obligation. You only exercise the option if it benefits you and you paid a premium for that flexibility. But there is another side of every contract. Just like in life, every right is someone else's obligation. And that's exactly what happens with options. The option seller takes on the obligation to deliver or buy the underlying asset at the agreed upon price within the agreed time frame if the buyer chooses to exercise. In this video I will walk you through the rights and obligations of both the option buyer and the option seller, the risk profiles of selling puts and call options, a practical example of selling options on Microsoft stock based on the setups we covered in the previous videos, and finally we will discuss when and why selling options can make sense and how it can be profitable. Let's start with a quick overview. In the table on the screen you can see who holds the right and who carries the obligation in the option contract. The buyer of a call option has the right to buy shares at fixed price if the market price goes higher. The buyer of a put option has the right to sell shares at fixed price if the market price drops. Both of these scenarios were covered in the first two videos of this series. Now let's look at the other side of the trade, the option seller. The seller of a call option is obligated to deliver shares to the call buyer if the option is exercised. This happens when the stock price rises above the strike price. If the option expires out of the money, meaning the buyer doesn't exercise it, then the seller keeps the premium. The seller of a put option is obligated to buy shares from the put buyer if the option is exercised. This happens when the stock price falls below the strike price. If the stock price rises and the option is not exercised, again the seller keeps the premium. This means that the option seller collects a premium in exchange for taking a contractual obligation. They keep that premium if the option expires worthless, meaning the buyer chooses not to exercise their right. In other words, the option seller is getting paid to take on the obligation that allows the buyer to enjoy their optionality. Now let's look at the risk profile, starting with the short call option. Selling a call option is typically a bearish strategy. The seller expects the price of the underlying asset to go down or stay below the strike price. When you sell a call, you are agreeing to deliver the underlying asset, for example shares, if the buyer decides to exercise the option. That will only happen if it's profitable for the buyer. In other words, if the market price is higher than the strike price. For the buyer, this means they can purchase shares below market value. For the seller, it means they must deliver shares at a loss lower than what they are worth on the market. So what's the trade-off? The maximum profit for the call seller is the premium collected when the option was sold. But the risk is theoretically unlimited, because if the stock keeps rising, the seller is still obligated to deliver. And it doesn't matter whether the seller already owns the shares, a covered call, or whether they have to buy them on the current price from the market to fulfill the contract. In either case, they might be forced to sell at a loss. On the other hand, selling a put option is a bullish strategy. The seller expects the price of the underlying asset to rise or remain above the strike price. As with call options, the maximum profit for the seller is limited to the premium received. The risk, however, is defined by how far the underlying asset could fall. All the way to zero is the worst-case scenario. When you sell a put, you take on the obligation to buy the underlying asset, such as shares, if the option buyer chooses to exercise the option. This will only happen if the market price drops below the strike price. For the buyer, this means they can sell the shares above the market value. For the seller, it means they have to buy shares at higher price than they worth on the market. Just like with calls, the seller maximum gain is the premium received, but the loss grows as the stock drops. It reaches maximum only if the price hits zero. If the price falls below break-even point, the put seller will be obligated to buy the asset at a loss. Now let's see examples of the following scenarios. Selling a put option and the asset price rises, selling a put option and the asset price falls, selling a call option and the asset price falls, selling a call option and the asset price rises. Let's return to the Microsoft example from the previous videos, specifically the stock price on September 1st. In those earlier examples, we were the buyers of the options. This time, we will take the other side of the trade. We will be the option sellers. Let's say that on September 1st, the Microsoft stock is trading at $430. Expecting the price to rise, we decide to sell a put option. The contract details will be the same as in the put option video, but this time we are not buying a right, we are selling an obligation. So instead of paying a premium, we collect it. Option price is $20, multiplier is 100, strike price is $430, and expiration date October 15th. By selling this option, we take on the obligation to buy 100 shares of Microsoft at $430 at any time up to October 15th if the stock price falls below that level. In exchange for taking on that obligation, we receive a $2,000 premium. $2,000 is because $20 times 100 shares. If Microsoft stock price rises over the next few days and closes at, let's say, $480 on the expiration date, the option buyer will not exercise the option as I explained in the put option video. In that case, the option expires worthless, and we keep the full $2,000 premium as a profit. It's important to know it doesn't matter how far the stock rises. Even if the price goes to $431, $500 or $600, the option still expires worthless because the buyer wouldn't benefit from selling shares at $430 when the market price is higher. So our maximum profit remains $2,000 no matter how large the upward move. If the price of the underlying asset falls below the strike price, the option holder may choose to exercise their right. In that case, the magnitude of the decline becomes very important because as the option seller, you are obligated to buy shares at $430 even if they are only worth, let's say, 370 on the market. The deeper the price drop, the larger your potential loss. Of course, you are not forced to sell those shares immediately. You could hold them and even sell covered calls options on them in the future, which I will cover in the future videos. But to do that, you need to have sufficient capital in your account. If you don't, the broker will settle your contract in cash, resulting in an immediate realized loss equals to the difference between the strike price and the market price. Now let's look at the call option example. Again, on September 1st, Microsoft is trading at $430 and you are bearish on the stock. In this case, you might choose to sell a call option. Option price is $15, multiplier 100, strike price 430 and expiration date October 15th. By selling this call, you take on the obligation to sell 100 shares of Microsoft stock at $430 but by any time before October 15th if the stock rises above the strike price. For taking on this obligation, you collect $1,500 premium. If Microsoft stock declines in the following weeks and it's trading at 470 at expiration, the option holder won't exercise the call, as we discussed in the call option episode. In that case, the option expires worthless and you keep the full $1,500 premium. Just like with selling puts, the size of the price move doesn't matter here. As long as the stock closes below the strike price even by $1, the buyer won't exercise the option. Even if the stock drops to zero, the call still expires worthless and your profit is limited to the $1,500 premium you received. If the price of the underlying asset rises above the strike price, the call option holder may choose to exercise the right. In that case, the extent of the price increase is very important because as the option seller, you must deliver the shares at 430 even if they are trading for much more on the market. To fulfill this obligation, you can either sell shares you already own or buy shares on the market at the current price. If you don't have enough funds to purchase and deliver 100 shares, the broker will cash settle the position and deduct the loss equal to the difference between the market price and the strike price directly from your account. And what happens if you sell a put and buy a call at the same strike price? Let's say you sell a put for $20 and you buy a call for $15, both at the same strike of $430. You collect a net credit of $5 and in return you hold position with unlimited upside from the long call and unlimited downside from the short put. This structure is known as synthetic long position. On the risk chart, you will see that this setup mirrors the behavior of the underlying asset. As the stock price rises, the position gains value. As the stock price falls, the position loses value. One very handy use case for a synthetic long, particularly for European investors, is gaining exposure to US ETFs that can't be purchased directly due to regulations. A synthetic long allows you to replicate the exposure using options instead of owning the asset. And conversely, if you sell call and buy a put at the same strike, you create synthetic short position. This relationship is based on what is known as put-call parity principle, one of the fundamental concepts in options theory. I will explain that in more detail in one of the upcoming videos. Whenever you open a synthetic position, remember, options have an expiration date. You can't hold the position indefinitely like you would with shares. Once the option expires, you will need to close the position, realizing a profit or a loss, or possibly roll into a new one. So, if the risk is unlimited and the profit is limited, why would anyone sell options? Fair question. While it's true that selling naked options comes with asymmetrical risk, limited reward, and potentially unlimited loss, there are many strategic scenarios where option selling makes sense. Let's have a look at few common use cases. Lowering the cost basis of a stock. By selling a put option, you are essentially offering to buy the stock at a certain price. If assigned, you might end up buying shares at a discount, effectively reducing your entry cost. This is a popular method for acquiring quality stocks at better price. Generating income from stocks you already own, selling covered calls or running strategies like the wheel can help to generate consistent income from positions you already hold. You get paid while waiting, and that cash flow adds up over time. Short volatility strategies. Options are often overpriced due to market expectations of future volatility. If you believe that volatility will decrease, selling options can capture the difference. This is the logic behind short volatility plays. Profiting from time decay. Every day that passes, options lose value. As a seller, that's a good news. You are not just betting on direction, you are betting on nothing happening and getting paid while you wait. Market neutral strategies. Certain option spreads like iron condors or straddles are built to profit when the market goes sideways. These are ideal when you expect low movement and selling premium makes the most sense. Complex spreads. Advanced traders often sell options as part of multi-leg strategies such as broken wing butterflies, iron condors, and credit spreads. This combination creates custom risk-reward profiles with defined risk even when selling options. Risk hedging. Selling options, especially in the context of put-call parity, allows for sophisticated hedging structures where you manage risk and exposure with mathematical balance. Selling options is not about being reckless, it's about being systematic. With proper position sizing, risk management and clear plan, option selling can be a powerful tool in a trader's arsenal. Of course, this isn't a complete list of all the possible use cases for selling options, and it won't be covering them all in this video. But I would love to hear from you. Let me know in the comments which topics you would like to see covered in the future videos. To summarize, every right comes with someone else's obligations, and that applies directly to options. The option seller enables the option buyer to exercise that right. That means taking on the obligation to deliver or purchase the underlying asset depending on the contract. For taking on that risk, the seller receives a premium. If the buyer chooses not to exercise the option, the seller simply keeps the premium. You sell a put when you expect the market to rise. You sell a call when you expect the market to fall. From the seller's perspective, maximum profit equals premium collected, just like the buyer's maximum loss. Potential loss is theoretically unlimited, just like the buyer's potential gain. The advantages of selling options: you can profit from declining volatility, you can benefit from time decay, you can use them to buy more complex multi-leg strategies. On the other hand, option seller has limited upside and, most importantly, the need to manage unlimited risk, which is absolutely possible but requires structure and attention. If you found this video helpful, give it a like, subscribe to the channel and share it with someone who's starting their journey with options. For more content, frameworks and examples, visit the blog at optionwise.eu. You will find articles, tools and free resources to help you build clarity and structure in your trading.